What is maybe an unpopular opinion you have about search that other people may not share?
There has been a lot of noise around search, and we've kind of touched on that a little bit around social media. And I think that in some ways that's been great because it's opened the opportunity up to a larger audience, and more people see this as a potential path in order to both build wealth and maybe provide themselves a different quality of life and a different opportunity set than they would have had otherwise. So I'd say unpopular opinion is search is the double-edged sword. I love the space. I've gotten the opportunity to teach it recently. And so I obviously love the ETA space. I'm really excited about opening the world up to other people. But I also want to be transparent about the challenges. And so that's the way that I start out the class. And anytime that I'm educating people is kind of what you talked about too, is some of the stories that are a little less than success, where people didn't just print money and throw gold coins in the air. It's a great path. There's a ton of opportunity, but somebody really has to commit to it.
You're listening to Before You Buy or Sell a Business, hosted by Jared Johnson, the top SBA lender in the country. On this show, we break down business acquisitions, talk to industry pros, and provide real-world advice for buyers and sellers.
All right, welcome back to Before You Buy or Sell a Business. Today we have Jacob Hall on the podcast. Thanks for coming by.
Yeah, thanks for having me. I'm excited to be here.
Yeah, me too. I'm excited to talk about something that we don't always get to talk about. We're going to talk about kind of investing in ETA. So maybe give us a brief background on you and how you ended up in this crazy world.
Sure. I think I probably took about the most indirect route ever in order to be involved in the investing in private equity space. So my background is really more of an operator. So my entire career has been in the operations space. So I've got an undergraduate degree in mechanical engineering and been in various operations roles across large organizations, small organizations. Started as an entrepreneur whenever I was a kid, and then from there it kind of progressed. So my career was largely in big corporates, operations roles, multi-unit management, things like that. And then I dropped down and worked in a small business, kind of around the size that most people are acquiring today. Went there as a unit manager. They did manufacturing and field service, ultimately ended up as their COO. And so that's where I got my first real exposure to the internal workings of a small business and the exciting space around it. Ended up leaving there and finally found my way back around to another corporate and went to a company called Noble Energy that got acquired by Chevron, did various other operations roles there. Around that time, I went back and got my MBA and went to the University of Texas at Austin and really decided that I didn't want to do the big corporate thing anymore. I'd had a lot of experience in operations and in leading companies. And so decided that I was going to go out and just acquire a company. I had no idea that search existed or had never really heard of the ETA space. This is probably around 2020. And so that's whenever I started looking for businesses to buy, and somebody kind of stumbled across ETA. Somebody said, hey, this sounds like search funds. And I was like, what is a search fund? And I guess as they say, the rest is history. So from there, I pretty quickly pivoted into investing in the space instead of looking as an operator role. Found out that there was more investor money that I had access to, other high net worth individuals as well that wanted to pull together capital to be able to get in these deals. And so started doing that deal by deal, and now it's my full-time gig. So really love the SMB space and kind of a rather indirect route to getting the investing space too. I think most people come from a PE or IB background, not the operation space. Yeah,
it's interesting. I think it's kind of funny because I feel like a lot of people didn't realize they were a quote unquote searcher when they were searching. And of course, 8-9 years ago, nobody really called it search. I mean, there was kind of a couple of the business schools that were talking about it or had the idea, but it was very different than it is now. So it's kind of funny when you have people that you talk to and they kind of say, well, I'm looking to buy a business, and someone's like, so you're a searcher? What do you mean? And so it's kind of like, I guess maybe trying to make it a little more professional and more uniform. So it's kind of interesting how it's evolved and continues to evolve. So maybe what we could do is just a quick 2-minute spiel on kind of what you do in the space. There's probably a lot of listeners that don't completely understand how it works, or maybe they just kind of have 2 inches and they need to hear the whole thing. So we'll let you go ahead and do that.
Yeah, absolutely. So most of my efforts right now revolve around investing into small business deals. So I run a firm that invests into self-funded search primarily and also into independent sponsor deals. And so what that really looks like is as people are going out and looking for a business to acquire, a lot of times once they find something, they may not have all of the equity injection that's needed to be able to facilitate the transaction. We get brought in order to evaluate the opportunity as well, and then look to partner with them both through the acquisition process up until the closing point, and then also to provide some value post-close as a partner for them. And so what that can look like can vary pretty widely depending on the style of transaction. So we might do some of the stuff that's kind of towards the smaller end, even of the SBA scale, and then all the way up into larger independent sponsor transactions. But most of our work is focused around the ETA space.
Okay. And do you have a minimum or a maximum amount that you'll put in on each deal?
Yeah, for the most part, we're looking to invest around between 100 and 500,000 into each deal, with the capability to go more than that if we find something that we really like. But as far as the firm and the fund that we're investing out of now, we're looking to write check sizes kind of in that range.
Okay. And so you're raising capital from individuals, from, where is the capital coming from?
Yeah, primarily from high net worth individuals. So everybody has to be an accredited investor in order to participate in the fund. And so the most of the people are either entrepreneurs, current or former, corporate execs, other people that maybe have a little bit of an investing background. So the range is pretty wide, and also some institutional. So people that might be in a more of a family office type situation look to deploy capital in the area as well.
Okay, that makes sense. And do you have maybe a specific goal, or, are you looking at certain industries? I know some people have kind of, something they're focused on, whether it's, a certain type of space or a certain type of individual that's operating. Do you have anything that kind of sets you apart from other funds?
I think so. I think there's a couple things that are a little bit unique. So one, we tend to take a little bit broader lens about the opportunities that we look at. So a lot of times in ETA and in search in general, you hear, recurring revenue, a lot of the components that people want. But in actuality, those deals are really hard to find and they're few and far between. And so sometimes you have to open the aperture in order to look at other types of opportunities. So that being said, we primarily gravitate towards B2B opportunities, with some B2G or a little bit of B2C if it's services based. So I would say that the main thing that drives the decision-making process for us is how discretionary is the opportunity or the product or service that they're selling. So if they're in a business that's highly discretionary, think restaurants or clothing, fashion, things like that, e-com, it tends to be things that we stay away from. Things that are a little bit more needed or that are less discretionary, then that's usually what our targets are. But outside of that, fairly open. I would say one other unique thing about our firm versus a lot of others in the space is that we will also invest on more of an indefinite hold period rather than just ones that have a defined exit. And so we can definitely dive into what that looks like because those are two very different profiles. But a lot of times that's helpful in the search space because some people are acquiring a business with no real intention to sell. They're not trying to do a private equity model. They want to hold this and have that be their legacy. So we're able to partner on those types of transactions as well as the more traditional kind of buy, grow, and sell opportunities that people are more familiar with.
Yeah, that makes sense. That was going to be kind of the next thing I was going to try to talk about was, kind of the different philosophies within a fund. I know, and we'll probably get to this, but some of the SBA guidelines have changed in the last month or two. But as it relates to your fund, like you kind of alluded to, some people will buy and hold. Some have I think a typical is like 7 years where you're trying to kind of return that capital or get a return. Do you have to disclose that to investors? Do you have investors that come along and say, hey, I'm good with that? Or, maybe they're looking for a certain period of exit. Maybe you could kind of talk a little bit more about how those funds can be a little different.
Yeah, absolutely. So I think that the key thing is alignment. So both between myself and the investors and also between us and the entrepreneurs that are doing the acquisition. So understanding what the game plan is for the business going into it if we're looking at potentially making an investment. So maybe start at the investor side. Most of our investors are very patient. It's patient capital. It's invested. They know that it's not a liquid investment. It's not like a stock that you can go and buy and sell or trade easily. So they tend to be people that have a little bit more of a long-term mindset. They're looking at growing wealth and building value over the course of time. And that tends to give them a little bit different perspective than, say, somebody who's kind of looking to get in and out of a particular opportunity. So I'd say alignment with the investor base is pretty important because that does give us some flexibility to be able to stay involved in businesses for the long term. The flip side of that is alignment with the entrepreneurs. So understanding what somebody's plan is post-close and whether they intend to hold that long term. I think sometimes entrepreneurs are a little bit nervous about saying, hey, I don't want to sell this. Am I going to be able to get investors if I don't really have an exit plan? And I understand that thought process, but for us, it's about understanding if you do want to hold it, then how do we achieve liquidity? How do the investors be able to get a return on their capital? And so that's where the planning up front usually goes into figuring out what are the plans for return of capital? Is there going to be dividend distributions? Is there going to be recapitalizations? distributions, or any other type of events that might occur over the whole period. But for us, I think that it's alignment about what the objectives are. And so we've been very lucky to have a great investor base, and also we've been able to partner with some really good entrepreneurs. And so being aligned up front tends to make the ups and downs of the whole period go quite a bit better.
And do you have a minimum that investors need to put in?
Yes. So any of our investors have a minimum of $100,000 is the minimum, but we do that over the course of 5 capital calls.
Okay.
So we're not calling all, say, 100,000 at one time. We're calling that over a period of time, around 2 to 2.5 years in the case of our fund. And so that allows the investors to be able to keep that capital at work wherever they may have it. And then over time, we're calling that to put into investments that we're making.
It makes it a little easier when, every 4 months or, hey, you got to put in 20,000. Okay.
Yeah,
it's not as bad.
Absolutely. I think it makes the asset class more accessible for a larger group of people. Obviously, they still have to meet that accredited investor threshold, but as they're trying to build a balanced portfolio of investments, that's a way for them to be able to deploy and to rebalance a little bit where they're getting exposure to a really great asset class, but without necessarily having to write one gigantic check up front into the space. It also gives them a little bit of the ability to diversify versus if they do have $100,000 to invest and they're going to go and put it into one deal or 2 deals, that really over concentrates their investment into those couple opportunities, which may be good or may be bad. By investing into the fund, they're going to get exposure to say 20 or 30 of those opportunities. And so it tends to de-risk the deal and allows for the targets to be focused on a little bit more than any one individual investment.
Yeah, I guess you could consider it kind of like roulette. You're covering a lot more numbers.
Absolutely. That's the name of the game, is that you're trying to get to the kind of the category, the asset class return and you want to get compensated properly for risk. And if you're just going into one deal or 2 deals, it really tends to up the risk meter quite a bit. And that's something that we want to try and build into taking away from those investors.
So then overall, do you have a set, goal on the return, or, and obviously you can't guarantee any kind of certain return, or is there something that you're shooting for? Yeah,
we do. There's investment targets that we make on an investment by investment basis. And then obviously we have a fund target as well. So the fund is targeted to return somewhere in the 20 to 25% neighborhood of IRR. That's primarily what we focus on. The individual investments are going to vary a little bit depending on what the game plan is for the hold period. So as I mentioned earlier, we've got something that's going to be able to distribute cash flow earlier on in the life cycle and possibly over the entirety of the hold period. It's going to have a very different cash flow profile than something that is buy, grow, reinvest, and then exit. And so being able to take both of those into account and the risks that come along with them as well is really important for us underwriting to each individual deal. So no 2 deals will be exactly alike because they won't have the same opportunity and they won't have the same risk. But depending on what the overall goal is for that investment, we'll underwrite to the expectation. But then as a blended average for the fund, that's kind of where we get our fund targets overall. So each individual investment is probably a little higher than that, but then underwritten as a whole, knowing that some investments perform better than others. That's how we get to our target for the fund.
So it's very different than kind of the VC world, which I feel like has definitely cooled off quite a bit. But they were kind of looking at it more of you make 100 investments and maybe one you get lucky and goes to 100x. Everything else you either going to lose or maybe you get a small return. You're trying to get a good majority of them to at least have some kind of decent return, but not anything where you're hitting a home run and they're going public or getting acquired by a larger company.
Absolutely, I would say I'm much more investment style of Warren Buffett than Jeff Bezos type investment. So we're not out there looking for grand slams every single time. It's always great to have that upside, but we're also looking at the downside risk and trying to mitigate that to the best extent possible. And so for us, being able to align on which types of investments we make and the people that are going to operate them post-close is pretty important to hit those goals.
So then are you required, or I guess it would be sort of strategy to try to pay attention to your portfolio as well, where you're not trying to do, 14 landscape companies in a row. You're trying to kind of mix it up a little bit. Are you paying attention to that as well?
Absolutely. And that's a great point that you make, Jared, because it's not just industry, it's also geographies and a lot of other things that come into account. Same thing we tend to mix investments between search and also some independent sponsor deals, which have a little bit different dynamics to them. Even the way that they're structured is different. And so we try try and mix all of those into the fund in the right proportion in order to get to what our target goals are. Same thing with, as I mentioned earlier, some things that are more longer term cash flow producing versus investments that might be predicated on a large exit or growth or M&A activity. And so we're going to look at all of those together of how do we match those opportunities together to try and mitigate the risk to the extent that's possible, but then also preserve the upside and get the returns that myself and the investors are looking for.
Okay. And if you don't mind, I'd like to dig a little further on the difference between the independent sponsor world and just kind of your traditional searcher. Maybe kind of talk about how they differ and then how you look at them differently as well.
Yeah, this is a great category to go down. I'll try not to go too deep down the rabbit hole, but those two worlds are really starting to collide a little bit. And so I think that whenever I start to categorize them in my mind, what is the difference? There's a lot of similarities, but I would say one of the main things is usually an independent sponsor deal is going to be a little bit on the larger end of the scale, and those go all the way up into multi-$100 million transactions. But for the ones that we're focused on, they're kind of at the upper end of a self-funded search deal and then exceed that. So I think that size is one factor. The other one is who's going to run the company post-close. And I'd say that's probably the biggest differentiator. And so most independent sponsor deals have a deal team or a management team that are going to find the deal and kind of be the overseers of that opportunity. But there's probably going to be somebody else who's going to come in and run day-to-day operations, a CEO or somebody like that they're going to bring in. Versus self-funded search deals are almost exclusively the owner-operator model. So they're going to buy that company, they're going to go in and they're going to be the boots on the ground every day growing it. And they're probably solely focused on that one opportunity versus in the independent sponsor world, they may have 2, 3, 4 different platform companies that are going at one time. So in my mind, those are kind of the main ways of differentiating it. I know a lot of people in self-funded search want to find that company that's hands off and, you just get checks mailed to your mailbox. And I know that's the dream.
Exist.
It does not exist. Yeah. Every week I end up having a conversation with someone who wants to do that or thinks, laundromats or car washes or something that they've seen on the internet. But for the most part, it's very difficult to find quality operators. And so that's where people that have experience doing it and a track record of performing in that space usually are the ones that get into the independent sponsor world. If you're a searcher, I would definitely say to focus on that first deal up front and make sure that it's successful. And then that will probably open up opportunities for you to be able to maybe add some resources or support, a GM, some other internal support. And then if your goals are to do multiple acquisitions, then you've got the ability to do that once you've kind of got a track record or a base underneath you.
Yeah, that was going to be my next question. So you're making this easy on me. So if you've got somebody that maybe their goal right away is to do a roll-up strategy, or maybe they kind of discover, hey, I did pretty well on this first one. I think I could replicate it. There's a need for it in this, said industry. Are you going to continue on the ride with them? Do you feel like almost obligated to?
I think this is one of the advantages that people have, and I'd love to dive into that part a little bit more, but I think this is one of the advantages of having an equity partner versus trying to raise all the capital yourself, is that whenever you do identify an opportunity like that, you may not have found that up front before you got into the industry, but whenever you have an equity partner with you, it's probably somebody that can grow. And so you might get into that company and realize, hey, there's a lot of room for expansion. There's some competitors. And once you're in the game, those opportunities tend to present themselves. And if you've fully funded that out of your own checkbook, then you might be totally tapped out in that one company. You're probably highly levered. Until you pay down some of that debt, no one else is going to provide any more new debt to you. So that's where an equity partner, I think, can be a real advantage, not just from the check writing ability, but also from growth, from strategy. Those are all things that a good equity partner should be bringing to the table, both before the close and after the close. And they should also be able to facilitate that growth. And so in a lot of cases, yes, we are along for the ride and we do try and help facilitate that. We're there to be able to be a good sounding board for them as well, of where investing for growth makes sense and where we're all going to get a good ROI for that, and where maybe growing just for growth's sake might not make sense either. And having a little bit of patience or growing organically might make more sense. So for us, it's a matter of working with that entrepreneur, because they're the driver at the end of the day. They operate it. They're responsible for the results, and we're there to support them in any way that we can, provide them resources, connections, network. But they're the ones who are really in charge at the end of the day. They're the operator, and we don't want there to be any confusion about that.
What kind of monitoring or, oversight do you have after the investment?
So it's pretty typical for us to ask for some sort of quarterly reporting that comes out, not just financials, but also a little bit of management commentary. And so that's kind of the bare minimum that I would say that we're looking for. We have some people that prepare really nice decks and do all kinds of things on a quarterly basis. We have other people that provide a little bit less as far as detail goes. But for us, it's just a communication thing. And I think it is a long journey together whenever we're investing in a deal, and there's going to be a lot of ups and downs throughout that whole period. The better the communication is between that searcher or operator and ourselves, probably the less unexpected surprises are going to pop up. I know it's the same way in the lending world. If something kind of goes off the rails, you want to hear about it first from the operator and from the person that you lent to, not, as you're just digging through the financials, go, what is this thing? And how come nobody brought it up? So I think that two-way communication is probably the biggest thing that we're looking for. Depending on the size of investment that we make, the size of the opportunity, the background of the entrepreneur, we might be looking for board representation or maybe to serve in an advisory capacity. But we're not really doing that for control reasons. More than anything, we want to do it to make sure that we're there to be available for the searcher. And we want to be there as much as they need, but not anymore, because we don't want to get in the way of them running the business. So I mentioned the multi-page, PowerPoint deck. If somebody wants to do that and that's their way of organizing the quarter's results, that's totally fine for us. But we don't want to be the one who's demanding so much information that it gets in the way of them running the business. And having been an operator, I was a COO, I've been in the driver's seat before. There's a lot of times where some of those tasks will get in the way of the actual running of the business. And that's the last thing that any of us want, both from the operator, the investor, the banks, everybody.
Yeah, absolutely. That makes sense. So if somebody's getting in trouble, or, maybe they need some advice or, some guidance on a certain topic, an operator's never going to be good at every single thing, right? I mean, they should be surrounding themselves with really good people within the business, but sometimes the company's not large enough, right, to have kind of a full C-suite. If you're paying attention, quarterly, or maybe they come to you and say, hey, I'm having an HR problem, or, I'm having a problem with working capital or something. Are you usually wanting to get involved in that as well and kind of trying to steer them the right way? Or do you try to stay hands off and then just take a look every quarter and see how they're doing?
I'd say we definitely want to be involved, especially if we can be an asset for them. And I think that's one of the advantages over taking some institutional capital like what we might provide versus high net worth individuals. So if you have somebody who's going to write a check into your deal, they may have lower expectations as far as communication or other elements of the deal, but they're probably not going to have a ton of value to add down the road, or at least you're going to need a whole bunch of them in order to have the different areas covered that you might need expertise. And so that's where we're available, not just myself representing the fund, but also our LP group is a really strong LP group. And chances are through that network, we're going to be able to introduce them to someone who has some experience with that topic, whatever it might be. And I think that's where a big advantage of taking institutional money. Just 2 weeks ago, I had an investment that we're working on, and they needed some kind of very specific industry expertise. It just so happens that one of our investors has former diplomatic and government experience, and I was able to introduce that LP to the buyer and let them do some talking about the specifics of that deal. And that was really, I think, a value add for the buyer, because they got access to somebody with knowledge that they just would never have been able to get, especially for free. And second of all, at the kind of level that they got and the brutal honesty that they got, or at least the transparency that they got from that person, because the LPs, invested in seeing a good outcome as well for the searcher.
Yeah. And as an SBA lender, that's something we want to see as well. I mean, we've had conversations about transactions with our credit department and kind of said, hey, I know this deal is not perfect. It's not a slam dunk. However, I've got, individuals investing here. This is what they've done. I know them. This is what they bring to the table. And it's sort of helped to get the deal over the finish line. So it might be a good way to shift gears a little bit. So with some of the changes with SBA, basically from my point of view or my understanding, what they were trying to cover in the latest update on the SOP on June 1st was mainly trying to make sure that the investors don't have control of the transaction. So, and the business basically after the fact. And then also trying not to get a kind of sort of set return that almost really looks like debt rather than investment. So did you have to change anything, within your fund, or, maybe kind of give me your opinion on that? I mean, feel free to, put it out there.
Okay. So I don't think that we had to change a ton internally. We were really lucky. I'd say that one of the SOPs that really changed things for some funds was the exclusion of anybody who was not a U.S. citizen. So not necessarily that they didn't have legal citizenship or citizenship here, but even just if they were a foreign investor based in the EU or anything like that. And I think a lot of funds were impacted by that in a way that we weren't. We were really lucky that all of our investors happened to be either citizens or permanent residents. So we dodged that bullet. But that is one thing that I think is on the radar for fund investors for sure. The second piece, which is really more what you were alluding to about control and mechanisms like that, I wouldn't say that affected us a ton. There is some verbiage and wording that might have to be changed a little bit in some of the operating agreements going forward in order to be compliant. But I think that our philosophy, and especially my own having been an operator, is we're not trying to tie the hands of the operator. And I know that the SBA kind of alluded to some bad acting by certain investors. And I haven't witnessed those terms or some of the things that they were really calling out. So I can't really comment as to how prevalent they were, but in the deals that I've participated in or the ones that I've seen, which is a pretty large volume, can't really say that I saw anything that seems like it would conflict with what the new SOP instructions were. But, just kind of on a more macro level, we want to be supportive for the entrepreneurs, but we're not there to run the company. They are the operators, and part of our vetting process and our diligence is making sure that we have confidence in them to be able to do that job. And we're making that bet up front as a minority investor. And so we're not just looking at the company and the industry and all of those things. We want to spend a lot of time to understand who's buying the company, what's their background, how does it align with the investment that they're making with this company, or what skin do they have in the game, how aligned are we for outcomes, what does the structure look like in the deal. And those are the things that we're trying to solve for in the deal. And if we find somebody that we think is trustworthy and that, has the requisite skills and they're going after a right company, that's what we're there for, is to bet on that person in order to put money into that deal and provide them with support in order to help them be successful. In no way, shape, or form do we want to be in a position where we're tying their hands or directing them how to run their business. We're there as a resource, and it should be a symbiotic relationship where 1 + 1 = 3. And if it's not that way, then I would say that somebody probably has the wrong investors, or they need to look for people that are more aligned with what their goals are or with what the needs might be for them personally. But I haven't really seen a ton of conflict with the SBA requirements. I think that probably the biggest one that I've seen that impacts things are put options, or that's something that's pretty common for funds to ask for, because funds do need to achieve liquidity in one way, shape, or form. And so I think that there's definitely some ways that can still be built in. And from the investor perspective, if a fund is closed-ended and they only invest in those deals that are predicated around an exit, then they have to have some sort of a path to liquidity for their investors. And so I think that might affect different funds differently depending on what their structure is. For us, it hasn't been a big deal because we're equity investors and we're cool with long-term investments. And we like, if a company is doing really well and performing well, the last thing that we want to do is force them into a sale or into a transaction. I think that's where middle market P has really gotten into a lot of trouble is, that one, right now they're having trouble achieving exits because of the liquidity issues in the middle market. But two, in the past, because they're driven by their timeline, they've forced a lot of sales that maybe weren't ideal. And that's the last thing that we want to do. That destroys value. And we don't want to do that with our entrepreneurs. We want them to drive the exit timeline. And so whenever they're going to exit should be up to them.
Yeah. The other side too is I feel like they had a lot of capital and they're like, we have to get this out. And so they may be making mistakes because they're like just throwing it at everything. You saw that in the oil industry, right? Pretty bad. Yeah, I agree with you, what you were saying, but I was seeing, some stuff. You guys saw some of those deals. Yeah. I saw some where you're looking at it and there's a large fee up front. It almost appeared to be kind of like hard money for real estate. So it was, a fee up front. There was a guaranteed return. It would be payment in kind. So like if they didn't hit that distribution, it would roll to the next year. They also would want some way of control. I even saw one that said, it's LLC, of course, manager managed, but they would have 2 out of the 3 managers would be the fund. And at any time they could vote out the other manager. And we're like, wait a minute, no. And so what was kind of unfortunate was in those cases, when I'm talking to the buyer, borrower, operator, they wouldn't really understand that. And so it sort of made me kind of want to take a step back and say, hey, you might not be the right person to buy this business if you're not even like reading this agreement. Yeah. You're not looking at the operator agreement. You're not looking at the subscription agreement. You're not really understanding what you're getting yourself into. That gives me pause when I'm looking at you as a borrower. You're going to actually be able to run this company. So we were seeing that. It wasn't a lot, but it was something that I feel like a lot of lenders probably weren't paying attention to. And so I think it was good for them to at least bring it to the attention and kind of say, this is what we're looking for. But on the other side, I feel like the SBA could have been a little bit more detailed and, is a little vague. We're hoping we'll get some more information and to be a little bit clearer, because until then we're trying to sort of interpret it the way that we think it's supposed to be. So
yeah, I think it's probably a little bit of a feeling out process right now for the lenders to try and, because the SBA was a little vague in what the requirements are. But whenever I'm having conversations with searchers, and I talk to them a lot, even pre-LOI, I'm happy to have conversations with searchers, get to know them and understand what it is that they're looking for. And if there's anything that we can do to help them out, whether it's a deal we're going to invest in or not, just love helping the search community. But one thing that I usually advise them to do is to think about the requests that are being made by potential partners, equity partners, and people like that. This should be a little bit of give and take. It is a negotiation, and these are people that you're going to be in the boat with paddling for a long time. And so if you find that any investor, whether it's an institutional, whether it's an individual, is really trying to drive the terms in everything towards their side of the table, and they're kind of shifting everything for their benefit, that would give me pause. And I know that whenever somebody's putting together equity for their very first deal, they're worried about getting the deal done, and kind of certainty to close is probably first thing on their mind. But I would say, to the extent that they can, to be very thoughtful about who they have as partners and to consider the behavior, the actions of people, because you want to be aligned with people that are going to treat you fairly. We're looking for that on the other side. If we have a searcher who's trying to find the absolute, how do I get every term to the bare minimum or to one side or the other, that tells us that maybe they're not looking for a partnership. They're looking for a transaction only, and they want the lowest cost market terms that are out there. And for us, that's just not a game that we want to play in. We want to find fair terms for everybody, where everybody's incentivized and where we're all going to do well. I'm huge on alignment, and so we want to see that searcher do well whenever we're doing well. And I feel like the more steps you can put in up front to align outcomes, the better off we all are. And the searchers should be very cognizant of that whenever they're thinking about who to take equity from, because it is a little bit like a marriage. You're going to be with somebody for many, many years. And even though they're a minority investor, they can definitely make life difficult, or they can make life much better and be able to be a real value out of the transaction. So be a little wary and do some interviews on your side too. It's not just about getting a check from someone.
It makes sense. So you sort of answered my next question, of course. Is there something that specifically you're looking for when you're sort of having those initial conversations with a searcher that immediately makes you lean to yes or no?
I would say that a little bit of maturity around how well they understand the process and the deal. Most people in the search world, it is their first deal, and the independent sponsor space, not so much. So you usually get more experienced buyers in that space. Self-funded search, it might be their first deal, and so it's okay that they don't know all of the inner workings of it, but we want to make sure that they have a clear-eyed view of what it is that they're getting into. If they are responding to prompts from social media about, they're not going to put any money down. I had an email last week, and someone said, well, why would I put any money into it if I can get all my investors to pay for all of it? And I was like, I guess if you can get investors to pay for all of it, then that might be a path for you. But in our view, we want to see that there's alignment between us and them. And so I'd say understanding a maturity of the process, and then also background. So we want to make sure that there's some sort of a fit between them and their either education, work experience, some combination of that, and what opportunity they're looking at. It's very different to be on the financial side of a transaction versus the operating side of a transaction. And I think that's a big bonus for me, having been involved in both sides of that. And so I'm trying to ask questions to gauge their understanding of what it's going to be like to be an operator post-close. And do they have that P&L experience? Do they have experience leading a team? It doesn't mean that they had to have done that exact industry, but it does mean that they have to have transferable skills to make us comfortable with the fact that they're going to be successful once they get in that role. And I think that that's a very important piece. It's not just about the company, it's about who the buyer is. And so if they've got a background that's, say, purely white collar their entire career, and then all of a sudden they want to go buy an 8-person plumbing company, I'm not saying that they can't be successful doing that. And in many cases, there might be a strong reason why. They might have worked in, the buy-side PE in that space. They may have had family that was in the trades. A lot of reasons why that could make sense, but we want to see the tie between that before we invest in it. Because if it's just strictly about the financial pieces, then that's not really a fit. That's kind of the bare minimum filtering mechanism to decide whether or not they want to pursue an opportunity. There really needs to be some alignment. So I'd say that's kind of the first pre-screen. Is what is their background? How does it fit with the opportunity? And do they have a mature view of what the future looks like? You can usually witness that pretty quickly through a conversation. You can witness it through their projections. Whenever we get a financial model from them and, everything is always up and to the right, sometimes we'll see a little bit more thoughtful projections where they're, especially in the early years, they're looking at expenses possibly rising, maybe the impact of the J curve, all of those things will drive us to see and understand a little bit more maturity on the part of the buyer, versus if everything is up 20% per year, then of course every financial, every statement is going to look good if you do that. And so I think that understanding the maturity behind it and them where they're at in that process and the fit behind the business are all important components.
And, having done this for a little while now, are you seeing maybe a common problem that operators are having post-close?
I think that most of them, not necessarily a common problem, but I would say that the J curve is something that people continue to discount. And there's a lot of reasons why it occurs.
So maybe you can explain the J curve.
Sure. Sorry.
No, it's okay.
Just throwing out nomenclature.
Yeah. I mean, you and I, this is how we talk all day, right?
Yep.
So we get used to it.
So the J curve, it's pretty common after a business closes for there actually to be a little bit of a dip, maybe revenue, maybe profit. And there's a lot of before recovering and then hopefully doing better. And there's a lot of reasons that I think that occurs. There's a lot of uncertainty or whenever the transaction happens, from the employees, the vendors, the customers. And so there's a ton of uncertainty that's going on in that amount of time. It's kind of like the moment where an airplane takes off and it kind of shudders a little bit. And you're like, wait a second, are we going up or not? Same thing's happening during that transition period. And so things get a little bit shaky. You're trying to solidify that base and get through that before you move on to growth initiatives and things like that. So it's really common in the J curve to see things go down a little bit, especially in year one before going back up. Once they have their arms around everything, maybe they've had to invest some money to fix some things that were existing. And so I would say that one common thing that I see is that a lot of buyers continue to dismiss the J curve or only consider success cases. And I think that it's really important to stress test your model and your thinking. And that comes in a lot also with how much equity or working capital that they're putting into the deal. And that's something that I think people have commonly overlooked. The last year, I've heard a lot more people talking about working capital because I think that so many people have been burned on it that that's a common one for people to miss. But good lenders like yourself are usually having that discussion with them as well about, hey, you're looking at it from your perspective. And then also us as investors are saying, just because you can finance something X amount, you want to make sure that you have sufficient liquidity because cash is king in a small business. And while you can have profitability and grow yourself into bankruptcy if you're not really careful. And so understanding the cash flow needs of the business is pretty important. So say maybe J curve and working capital stuff is probably the thing that surprises new buyers. I wouldn't say necessarily that's a problem, but something that they should definitely be aware of if it's their first time going into it. It becomes very real whenever you're trying to figure out how to pay payroll.
Yeah, it's interesting. Having those conversations with people, especially if it's their first time, and trying to get them to understand, you need working capital. Oh, I don't want to get too leveraged. I don't want to borrow it. I'm like, okay, I agree, but at the same time, like, just trust me on this because there's so many things that come into play right away. And once I start kind of explaining all of the different things that can come into play as soon as you take over, and from my own experience too, seeing it, buying businesses, you see. I'd say probably one of the biggest things that you need working capital is just getting approved as a vendor with so many different things. If you deal with the government, forget it. You have 6 months most likely before you're getting paid. So you may be doing work. So, looking at it as a J, so your revenue is coming down. A lot of times your expenses are going up at the same time. And then your revenue hopefully goes back up like a full J. It never is a hockey stick straight up. And so people get, a little blinded by, or maybe they're, listening to social media a little too much, but they don't have an understanding that it's going to go down and it should come back up, especially if a lot of the expenses and a lot of the reason that the revenue is going down is because you're focused on something else that is going to propel the business long term. And like you said, so many people don't understand that. They think like, I'm going to walk right in and it's just going to be business as usual, or I'm going to apply the, 12 things I learned in business school and it's just going to go straight up. And they don't realize that there's a lot of different things that can go wrong. So I'm glad that's what you said people are worried about. So I'm always like, just take the working capital, pay us off early if you'd like down the road. Talking to a searcher yesterday on the phone, he's telling me, my capital position has gone up by almost $1 million since I took over the business. I'm like, great, keep it there. Yeah. Just keep going because you don't really know what could be coming next. Use it to grow, use it to reinvest. And, so people can get a little off, when it comes to that stuff as well.
Yeah, I agree. And I think that this goes back earlier to our conversation about maturity and things like that for the buyer. Being able to understand the importance of working capital comes through pretty clearly whenever somebody says, hey, I'm doing this and this and this. Same thing whenever they're looking at maybe taking outside equity. I know no one wants to have less equity in the company, but if you own 70% of a successful company or 75% of a bankrupt company, I would argue it's better to own 70% of the successful company. And that's where also maybe not going to the absolute minimums for SBA funding, things like that, can buy you a little bit of breathing room that on paper, it doesn't, you're looking at a spreadsheet and it says, oh, well, I should lever it as far as I can because that's what's going to get me my max return. In the real world, having a little bit of breathing room there for the unknown and for you taking on a new challenge is pretty important. And I think that's where taking that line of credit, if it makes sense to, that's where making sure that you're properly equitized, that maybe your debt service coverage gives you a little bit of breathing room for the unexpected. And that's another place of where bringing in equity partners can be pretty valuable, I think.
Yeah, definitely makes sense. Yeah, we get quite a few people that just immediately are like, no, I'm going to be great. Everything's going to just go. We're like, no, you need to hit the brakes here a little bit. So
I would always challenge them to go and talk to some people that have operated before, that have been through the process. I have not encountered a single entrepreneur that has acquired a business that has told me this is the easiest thing ever, just a nice smooth transition, and this is an easy way to make money. It's always really the opposite. And I think that people tend to look past that because they get so caught up in the search process. They forget that the end of the search is really the beginning. And operating has its own set of challenges that are unique and different to searching, but they're very real and they're very personal and they don't go away. You're in it to win it with that business. You're married to it. And so I think that making sure that you address as many of those up front and give yourself the best chance for success is important to everybody. The entrepreneur more so than anyone, but for the lenders, for investors, for everyone.
Yeah, makes sense. And I feel like people are finally kind of starting to be a little bit more transparent. We've talked a little bit about social media or kind of what they're seeing or what other people are saying. I feel like people are very, very scared to actually talk about failure and talk about what could go wrong. And there is definitely things that can go wrong when you're buying and trying to operate a business. And one of the very first times I actually heard somebody start to talk about it, I was like, yes, finally somebody. And they had said, if I could go back and I could change it, I would have taken more, investment. I would have tried to have lower leverage because there's been a lot of opportunities that I've seen, but I don't have the capital to actually invest and take them on. And when I tell people that, a lot of times they're kind of like, what? Like, you're a lender, like you should be trying to get max leverage, right? So that's how the bank makes money. And I'm like, no, but what good is it if you struggle, you don't do well, you're failing, at the end of the day, we all want the program to continue to move forward. And so I'm glad you brought that up. What is maybe an unpopular opinion you have about search, that other people may not share?
I think, this one's a loaded question, isn't it? I think that there has been a lot of noise around search, and we've kind of touched on that a little bit around social media. And I think that in some ways that's been great because it's opened the opportunity up to a larger audience, and more people see this as a potential path in order to both build wealth and maybe provide themselves a different quality of life and a different opportunity set than they would have had otherwise. The flip side of that is that focus on this area has also brought a lot of people in that are kind of what I would call tire kickers or search curious, that are interested in the space and it really sounds appealing, but that maybe aren't quite at the point where they're ready to buy or ready to jump off there. What it's done from a buyer's perspective is that it creates a lot of noise in the marketplace. And so it's made it more difficult for some of the buyers to stand out in the marketplace. And so then what happens is sometimes transactions get lost or multiples get bid up that then don't end up closing. A lot of things end up happening as a result of that, some of the knock-on effects. So I'd say unpopular opinion is, search is the double-edged sword. I love the space. I've gotten the opportunity to teach it recently. And so, this fall, I'm actually teaching entrepreneurship through acquisition at University of Texas at the McCollum School of Business. And so I obviously love the ETA space. I'm really excited about opening the world up to other people, but I also want to be, transparent about the challenges. And so that's the way that I start out the class. And anytime that I'm educating people is kind of what you talked about too, is some of the stories that are a little less than success, where people didn't just print money and, throw gold coins in the air. And so I think that it's important for people to be exposed to both sides of that so that they can make a clear-eyed decision. It's a great path. There's a ton of opportunity, but somebody really has to commit to it. Maybe one of the more controversial topics that I'll jump into. It's very hard to go out there and find a quality business part-time. And there are different ways. Some people have different ways that they can address that. But if you aren't really out there giving it your all, it's pretty difficult to beat somebody who is putting 50, 60 hours a week into it. And so if you're trying to do that on the side, you're going to have to get a lot more creative with leveraging tools or technology, or hopefully you have a really flexible schedule. But it's pretty hard because it's becoming a very competitive marketplace to get the best deals at a price that makes sense. So you don't want to go out there and just overpay for a company so that you can get in the game, because then you created a whole new set of challenges. So I would say the focus and the attention has been a little bit of a double-edged sword, both good and bad. For us as a equity provider, it's kind of like you guys as a lender. You want to see a lot of people in the game and a lot of transactions happening, but individually, and I know you feel the same way, we only want to see people that are doing it that have a good chance of success. Not that it's guaranteed, but we don't want to see people going into it without understanding what the risks are and the challenges that they're going to face. And so we want there to be that balanced view of it. And ideally, we get the right entrepreneurs out there that are doing the buying, people that we can support, or other firms like myself can support, the lenders can support. And I think that that's what makes the ecosystem strong, is getting that message out there to everybody.
Yeah, definitely makes sense. So, okay. So 2 final questions. First one, do you have a mentor, or have you ever had a mentor?
I did have a mentor pretty early in my career that did just a ton of things for me early on in my career, opened doors for me, helped me to learn how to navigate a lot of different situations. That was in my 20s, and I was pretty young and in a management role where I had 15, 16 stores, a couple hundred employees. And to be in your mid-20s and be doing that was a challenge, to say the least. Had a great mentor who helped to guide me through a lot of those circumstances. Now I would say that I found myself flipped. I'm older now. I've been kind of in the business world for about 25 years. So now I find myself in the mentor role for others a lot. And I really take a lot of enjoyment in that too, because it's a way for me to give back, because it's not just that one individual. There's been a lot of people who've helped me out along the way. And I think how I've gotten to where I'm at is asking questions, learning from other people, not having to repeat those mistakes. And so the compilation of that knowledge is something that I like to share and pass on to other people. It's one of the reasons why I wanted to teach and be able to give back to people that are in the community, because that's how I got here.
Yeah, it's perfect. Makes sense. So, okay, final question. What motivates you?
Oh boy. I love what I do. So I've worked in big corporate. I've worked in kind of the startup space, back to big corporate, been in the SMB world, did a little bit in VC, and the M&A side. It did just a lot of different things. I feel like what I'm doing right now is a role that is purpose fit for me, because I don't know any place where I could take the background in operations and finance and leadership and be able to put all of those things together into one opportunity that really is more custom fit for me. I didn't come over from real estate or from some other field into this. I've really been involved in business and in operations my entire life. I was an entrepreneur. I think I got my first business license at 13.
Oh, wow.
That they had to find out whether or not I could even get it since I was a minor, because there was no age requirement for it. So I've been into entrepreneurship my entire life. I love business. And so I love what I do. And I think that's what motivates me. I'm at a point in my career where now, luckily, I'm not just working strictly for financial gains. I want to be a good partner for our entrepreneurs. I want to be a good partner for our investors. I want to produce the things that I say I can produce. And I like to work with good people. I like to do good deals and work around enjoyable people. And luckily, I'm in a position to where I have some flexibility to do that. And so if someone is a fun person to work with, and I think that we're going to kind of vibe together, for lack of a better way, then I really want to work on those opportunities. And if it's somewhere where maybe we just don't see eye to eye, then I'd rather invest that time and energy somewhere else. But what motivates me is I just love what I do. Like I hate to say it out loud that I would do it if I wasn't getting paid, because I don't want to encourage bad behavior, but I just really love what it is that I'm doing. I love every day I'm getting to look at new businesses, new industries, new entrepreneurs, getting to help them out and share that knowledge and see them be successful and help problem solve with them. And I just can't think of a better way to spend my time or my professional career. I mean, life is too short to do something you don't love. And so I would encourage anyone, if you really hate what you're doing for work, then you probably should be looking for something different, because I get up every day and I know the difference, because I've been in roles where that was not the case. And so now every day, whenever I wake up, I really love what I'm doing, and I get to go out there and, it has its ups and downs like anything else, but it's just, I think, a love of the game, a love of small business, love of supporting entrepreneurs. I think that the community is great as well.
Yeah, makes sense. So, and that was a great answer. I totally agree with you. If you don't completely enjoy it, then, maybe try to find something else. There's a difference between making ends meet and making ends meet when you're happy.
Yeah.
Where can the searchers find you, investors find you? How can they find you?
So I'm not really on X or Twitter. I don't do a ton of socials, but I am on LinkedIn. So people are welcome to find me on LinkedIn. It's just Jacob Hall on LinkedIn, or then go to our website, Kando Capital. That's Kando Capital, CAPITAL.com. But most of our stuff comes through LinkedIn or via the website. But they're welcome to reach out to me, send me an email. They've got links on there so they can send an email to introduce themselves. Love to meet searchers, love to talk through deals and look at opportunities. So whether it's somebody who's on the investor side that wants to learn more about what we're doing, or specifically searchers, independent sponsors that are looking for the best equity partner, that's who we want to be for them and kind of what we pride ourselves on. So encourage them to reach out and find us.
Well, I know you're one of the good guys in the industry. I've enjoyed working with you in the past, and I feel like you genuinely care about the searcher, you care about the industry. So we appreciate that, and thanks for taking your time to talk, and hopefully we can catch up again sometime soon.
Yeah, thank you. Thanks for having me. I really enjoyed it.
Of course, yeah.
Appreciate it.
Thanks.
Thank you all for listening to Before You Buy or Sell a Business. If you found value in this episode, please follow the show, leave a positive review, and share it with someone. For more information, check out jaredwjohnson.com. We'll see you all next time.